Hi everyone, Andrew Marshall here. Today I want to talk about some research that came out in December 2023 in the Journal of Financial Planning that covers the widow's tax penalty. Now there are a lot of articles out there on the internet and in popular magazines about the widow's tax penalty, and I even made a video myself and posted it on my blog. But this new research is showing that it's really no big deal. Yes, it exists, but it is not going to change the surviving spouse's lifestyle, and also therefore there is no reason to do Roth conversions or to do other tax planning to try and alleviate this supposed widow's tax penalty, because it's really not that big of a deal. Let's take a look at the specifics. When one spouse dies, the remaining spouse does not have their income cut in half for two main reasons. One is Social Security. The remaining spouse gets the larger of the two benefits. They don't get half of the total Social Security benefit they were collecting as a couple. The RMDs don't change when one spouse dies because the remaining spouse will own all of the accounts and will still have to take all of the RMDs, so that portion of their income will not go down. Those are the two main reasons why a remaining spouse's income does not get cut in half, but their tax bracket gets cut in half. That is the widow's tax penalty. This table comes from the research paper, and it shows how the incomes and expenses will change for the couple and then for the single person who is the surviving spouse. There are three different income levels. To get an idea for what these different amounts are that were being discussed in here, the top of the 24% income bracket is $364,200 in 2023. You know, I don't see a lot of clients who have that kind of an income, so we'll just ignore that column. Instead, we'll look at the middle column, which is showing someone whose income is near the top of the 22% federal income tax bracket, which in 2023 is $190,750 of income after their deductions. So we're going to look at the middle column here, top of the 22% bracket. In this example, they are assuming that both people in the couple have the same Social Security benefit. So the remaining spouse has half of the taxable Social Security income that the couple did. The RMD stays the same because, you know, that's how it works. The second line is ordinary income. As a retired person, that means withdrawals from retirement plans or RMDs. It means pension income. What we're assuming here again is that they took the 100% survivor benefit on their pension. So the RMD pension ordinary income line stays the same after the first spouse dies. Then we've got the AGI. It's a little bit lower because of the difference in taxable Social Security. The standard deduction is half of what it was. The age 65 deduction is not quite half. And that gives us a taxable income that is about $18,000 less for the widow. Income tax, $29,500 versus $31,000. So it's true, there is a widow's tax penalty. $31,000 of income tax is more than $29,500. But their expenses will be different. Some of those are healthcare. For number one would be Medicare. That's going to be about half. IRMAA surcharges are for those who are in higher income. They will pay extra for their Medicare. And in this case, a single person with a taxable income of $154,000 would pay additional IRMAA fees for Medicare of $3,460. This next line, Social Security is got its own tax rules. So that's an adjustment to Social Security because of all the other incomes. That leaves a disposable income of $135,981 versus $173,434. That is a reduction for the surviving spouse of $37,453 in 1 year. Is that significant to the widow? Well, that's a reduction in their spending money and their disposable income of 21.6%. So the question is, was the other spouse responsible for more than 21% 0.6% of the couple's spending. Now, some of their spending would have been on fixed expenses like their house, their property taxes, their insurance. That's not going to change for the surviving spouse. It kind of depends on how much money the deceased spouse spent compared to the surviving spouse. If the deceased spouse was the one who spent a lot, did a lot of expensive hobbies, then the surviving spouse is not going to see a reduction in their lifestyle. The takeaway from this research is that although the surviving spouse will pay more in taxes, it's not significantly more. It's not so much more that their lifestyle is going to be diminished. Don't do Roth conversions early in retirement. It's not worth it for the idea of saving the surviving spouse from paying taxes. You'd be better off spending your money in your healthy early years of retirement, enjoying yourselves and having fun.